welcome to Bloomberg TV India. I'm Mitali Patel in Mumbai and these are the top headlines. The markets opened the day in the negative note. All the sectors are in the red. Realty is the biggest loser. Also, Asia trades mixed as investors are cautious on the markets post the recent rally. On Wall Street, the Dow extends gains while S&P snaps a 7-day winning streak. And the Interministerial Committee on the Disinvestment is scheduled to meet today to decide on the floor price of NALCO share sale. Those were the headlines. Up next is Market Guru.
Hello and welcome to Market Guru. I'm Samina Rani filling in for Vivek Law, and on the show today we have with us Vetri Subramaniam, Chief Investment Officer, Religare Mutual Fund. But before we get his view on the Indian markets, let's take a quick look at the market action.
Well, Samina, let's look at the screen right now. It's not been a very positive start. Asian cues haven't been very supportive, and therefore we are down about 0.5%, little over 0.5% right now. The Nifty is struggling now at 58.75. The dollar rupee, however, has had a very different trajectory. Lots of strength coming in on the currency in the last 2-3 sessions. That's continuing this Wednesday morning. Now it's reaching all the way back at that 54 mark. The export-import data has been very supportive for the currency with the deficit. That's the trade deficit actually going down. Sectorally speaking, you can see the run towards so-called perceived safety. So the FMCG index is holding up much better. High beta areas of the market like real estate are cooling off. The realty index down about 0.7%. Couple of stocks that we're talking about this morning. There's an interesting bounce back that's underway on some of the Bangalore-based real estate stocks. Prestige Estates, Puravankara holding up. Whereas Tata Motors, after the JLR numbers came out, is actually down 2%. JLR sales have grown only 3%, which is a lot weaker than what they've been doing in the last several months. It's the Chinese number which has been disappointing for JLR. NALCO is managing to hold its head above water. We should be having the pricing of the offer for sale by the end of the day today. The EGOM is meeting. And on Suzlon, some more pressure building in. The news is positive. They found bankers to back their bonds and the underwriters, but nevertheless there's some selling that's coming in, down 2.5% as the entire high beta space of the market takes a bit of a breather.
Joining me on the show is Vetri Subramaniam, Chief Investment Officer of Religare Mutual Fund. Thanks, Vetri, for joining in this morning. Vetri, to start off with, how are you feeling about the markets? Because the broader market move since the start of the year really would have disappointed most retail and HNI investors. Do you see it being a bumpy ride this year?
I think so, and one should budget for a bumpy ride because at this point of time the economic data is still quite sketchy. We haven't really seen a full-blown recovery. We are battling macroeconomic indicators which are pointing in different directions. So I think it is going to be a fairly bumpy ride at this point of time, and what we've seen in the first 2 months of the year is most probably a precursor to what happens in the rest of the year. Beyond that, obviously global correlations are still fairly important, and they've been fairly high in recent times, and I think they'll continue to be so. So that will be something that one will have to always watch in terms of what's happening in other parts of the world in their equity markets.
Vetri, then do you think flows might continue going into the rest of the year? Is it just the liquidity that's been driving the markets in the face of fairly anemic earnings so far?
I mean, the liquidity is certainly making a difference, but truth be told, nobody has a perfect sort of mechanism to forecast what flows might be in any given year or any given period. If at the beginning of 2012 you had suggested that we would see $25 billion of inflow, I don't think that was anybody's forecast. And so it's interesting to see that at the start of this year, everybody's forecast is that the flows will continue at the same pace. And the truth is that we really have no clue about what the flows will be. But irrespective of what the flows are, the truth is that over the last 4 or 5 years, or in fact even going back longer, correlations between our market and the global markets have stayed high, and therefore I would warrant that irrespective of what the nature of the flows is, those correlations are more likely to persist over time. I think in the near term, the challenge for our market in terms of what's been happening is more to do with the fact that we're a little bit unbalanced. The only net inflows that we are seeing into the market are coming from overseas, whereas in the domestic market, retail investors, whether it be through the insurance route or through mutual funds like us, have largely tended to redeem money. So I think the worry about flows, specifically in the context of India, is that we've got these unidirectional flows with only foreigners contributing to net buying and domestics contributing to net selling. So that, to my mind, is something which makes the Indian situation a little bit more different and potentially a little bit of a concern that we are seeing this very divergent pattern.
Vetri, the rupee recently at least has been on a weak link. How does that place the prospect of global flows? Because FIs recently at least don't seem too pleased with the currency and the amount it's taking away from their investments.
Yeah, I think if you look at the currency and what's happened over the last, 2 years, it's obviously depreciated quite significantly. But the truth is that even despite the recent trade deficit number that we saw, our trade deficit and our current account deficit remain significantly high and a cause for both concern as well as it's a significant macroeconomic risk for us. And really, while there are multiple things that need to be done to address the current account deficit, without doubt, one of them is restoring the competitiveness of India as a manufacturing destination, not just for goods but also for services. And really, one of the ways in which that is likely to play out is by a weak currency. So I think at some level, one will have to presume that as part of any adjustment process of the Indian economy and its attempt to address both the trade deficit and the current account deficit, is that the rupee is likely to stay weak currency in the next 2 to 3 years. And I think that should really be the operating principle for any investor looking at India at this point of time.
Vetri, how much of a recovery in price to earnings do you expect to see on the market? Do you have a target that the market may comfortably achieve over the next couple of months?
If you look at it in terms of PE ratios, we are now trading about 4 or 5% cheaper than our trailing 12-month average. If you look at a very long-term average of about 14, 15 years, about 17x is the trailing 12-month average. We're about 4 or 5% cheaper than that. My sense is that for this market to trade significantly above a trailing PE multiple of 17x is going to be very difficult unless we get very clear sort of belief that a earnings recovery is underway. Unfortunately, at this point of time, that is still not very clear. For the current year, earnings growth will be in single-digit levels, and for FY14, while the current analyst forecast is calling for about 13 to 14% earnings growth for a narrow market like the Sensex, I think there will be a 1 to 2% hit to that number just on account of the corporate tax surcharge. Obviously, that's only for 1 year, so presuming it gets lifted in 1 year's time, the next year's earnings will bounce back much stronger. But that's not always a given, and markets will have to price it in as such. So I think you really need to see the market gaining a lot more confidence in a 15% plus kind of earnings growth trajectory, which right now I think is looking very, very difficult. And the current forecast I think is more at about 12-13%, and even that's going to be a difficult number to get to.
Talking about those earnings, Vetri, before I talk about those macro triggers, do you think the fourth quarter earnings are going to be as disappointing as the third quarter, or is there a glimmer of hope this time around?
On the contrary, I think the fourth quarter earnings are going to be even worse than what we saw in the third quarter. Just look around you. I know we've seen some IIP data which suggests there's a little bit of an improvement. The PMI is indicating a little bit of an improvement. But if you actually look at the data points that we can track, things like automobile sales, commercial vehicle sales, cement sales, iron and steel sales, these are all sort of the early lead indicators that we get on the health of the economy. And we've also got some data from companies about the way their order books are behaving. Looking at all of this data, our broad sense is that this quarter is actually going to be very, very difficult for corporate India because there's absolutely no sign of recovery in any of these numbers that I spoke about. If anything, they've become worse than what they were in the previous quarter. Add to that another element which is now very clearly visible, that the government has clamped down very dramatically on capital expenditure to try and achieve its fiscal deficit targets. Now, in the long term, cutting the fiscal deficit is a good thing. But in the short term, when you clamp down particularly on capital expenditure to achieve those fiscal targets, it effectively means government spending drops dramatically. And that's now visible in the FY13 revised estimates which are available, which means that this economy will not see the typical fourth quarter budget flush that tends to happen, which is a boost to the economy. So, our worry in that sense is that actually these fourth quarter earnings may prove to be even worse than what we saw in the third quarter. And, that is certainly something to worry about.
Vetri, all the talk, at least recently, has been about the policy. The experience of the last policy is not very great. I mean, even though we did get some action from the RBI, Even if a cut does come through this time around, but the dialogue, the content of the policy meeting is very hawkish, how do you expect the markets to move or react to that?
Just to put it in context, I think, the current sort of expectation of reduction in rates is very different from the kind of down cycle in rates that we saw in 2008, 2009, or for that matter all the way back in about 2001, 2003. This time around, I think all that we are looking at is that to the extent that the data is supportive, there is some case for the RBI to try and cut rates, and it's likely that there will be another 50 basis points of cuts, most likely from here to December. So we're not really at the start of a very significant cycle down in rates, but at the margin it will certainly help the economy, even if the rates were to be cut by 50 basis points as compared to not being cut at all. So it's certainly something that would help the economy, but it's not the only parameter you need to look at. One of the challenges that we are currently facing is that the deposit growth in the system has turned extremely weak, which means banks are struggling to meet the demand for credit, even though demand for credit is also running much lower than what they expected. So despite RBI actions, we've had a situation over the last 2 months where in fact banks have been hiking deposit rates rather than bringing them down. So you see this dichotomy between what the RBI might want to do and what's happening in the real world, because the economic situation is still sort of blow hot, blow cold, with some part of the economy suggesting we're in the midst of a deep slowdown, and some other indicators like your trailing 12-month loan deposit ratio, your current account deficit, trade deficit, suggesting that the economy is overheating. So you're caught between these two extremes, and it's not a very nice situation to be in.
This is the new age algorithmic high-frequency trading-driven strategy.
A manufacturer leading all of down over down
Story that we are breaking for you right now here. Finance Ministry is not going to levy any extra tax. Coal India is unable to assure maximum fuel supply. Welcome to the big story. I'm Vivek Law.
आप मेरा मोबाइल चार्जर भूले तो नहीं ना?
क्या आप टेंशन फ्री लाइफ जीना चाहते हैं? अब अपने मोबाइल फोन से स्टेट बैंक फ्रीडम पे लॉग ऑन करके कीजिए मोबाइल टॉप अप। स्टेट बैंक फ्रीडम, तो हुआ ना आपका बैंक आपकी जेब में।
Clean energy, green technology and fresh thinking. That's why businesses are putting down roots in Ireland. A place where innovation comes naturally. Visit idaireland.com.
Promoted by Repco Bank Limited, a Government of India enterprise, Repco Home Finance Limited, a housing finance company with 73 branches and 19 satellite centers, primarily in Tier 2 and Tier 3 cities, now offers a public issue of 15.7 million equity shares of 10 rupees each at a premium. The 100% book building issue being offered in a price band of 165 to 172 rupees per share opens March 13th, closes March 15th. For details and risk factors, refer to the red herring prospectus.
Every CEO needs to know his market. It's about growth. It's about strategy. It's being on top of your game. It's really about getting started. Sometimes you need to throw people out of business to stay in business. What a CEO knows, what a CEO needs to know. Let's talk business. Watch in business.
The man with the right answers. For 19 years, he has fought relentlessly for your money, your rights. She has dedicated her life to spreading financial literacy. When it comes to personal finance, there is none better. Vivek Law, Monica Hullen, and when they get together, your money gets smarter. BSC Investors Protection Fund presents Smart Money.
Presented by BSC Investors Protection Fund in association with Axis Bank, बढ़ती का नाम जिंदगी।
just want to talk about what happened last week, and this is what we heard domestically, that part of the mid-cap carnage over the last couple of weeks was because of redemptions that were kicking in with ferocity, and a lot of the ULIPs as well came up for maturity. What, in your opinion, is happening with the domestic crowd? Is there still a lot of redemption pressure?
There is certainly redemption pressure, and I think that's been consistent across the mutual fund industry and the insurance industry as well. But looking at the kind of companies that got sold off very dramatically, and if you actually look at some of the biggest companies that had those breaking news kind of 50% down, 70% down kind of stories that flashed on television channels, most of those didn't have any significant institutional holding, be it mutual funds or insurance. I'm obviously generalizing here, but largely it would be true that they didn't have very large institutional holdings, at least among the domestic institutional investors. So my sense is that a lot of that had to do more with leverage positions than it did with really institutional selling. Clearly there has been institutional pressure in the market, but in terms of domestic redemptions, but I think the mid-cap pressure is more related to leverage positions that got sold down.
Vetri, is there anything happening in the primary market, both from the government and on individual company levels? I mean, we've heard that 3 to 4 OFSs are scheduled every week. Do you think that may actually put some pressure on the secondary market and the kind of flows it could have pulled?
Certainly paper supply will always be an issue in terms of determining which way the market behaves, and it's not just a question of OFS. As we saw in the month of January and February, there were quite a few companies which used that window where markets were buoyant and money was available to pick up large amounts of money through QIPs. So I think paper supply is something that we will constantly have to grapple with, and we need to look at paper supply in the right context. Yes, from the point of view of the secondary market, sometimes a lot of paper supply is obviously a little bit of a cap on performance. It soaks up the money flows. But from the more medium-term perspective, if you're looking at it from the perspective of sustainable growth rate for the economy, this economy is will not be able to grow at the kind of sustainable and healthy rates that we would like, unless companies are able to continuously raise money, particularly the companies which are involved in more capital expenditure heavy kind of segments, and they will need to continuously raise money. So I think in India you need to look at capital raising from both views, which is, yes, in the short term it could be a dampener, but if there is no capital raising, mind you, with some kind of a lag, it will actually show up in terms of hurting the economy in terms of its growth rate. So there has to be a fine balance, and I think markets will keep trying to evaluate where that balance lies.
But then what will work better with the current market and global conditions? Is it better to get into high beta now, or is it still safe to play defensives till there is a lot more clarity towards the later half of the year?
I don't want to get too much into terminology, because it can lead to wrong conclusions and wrong ideas. Our sense and of the right sort of portfolio approach is driven more by our thought process on where the economy is and what we are going through. And I think our thought process is the economy is still in a challenging situation. We yet to see any kind of clear signs that growth is likely to revive. Valuations are neither particularly cheap, but the good news is that they are not expensive either, so they are reasonably in fair territory. And the economy has entered a period of deleveraging, where all the companies which had overextended themselves during the whole boom of 2003, 2008, and maybe for 2 years they didn't do much about it, but now in the last 2 years they're starting to deleverage. So this is a fairly challenging period for the economy, and it may last 6 months, it may last 12 months, and any sort of recovery is only going to be very gradual. Don't expect this patient to jump out of the ICU and start running at 9% or 10%, which are at best aspirational rates of growth. Any recovery is going to be very gradual. Now, in that context, our approach is more that we need to pay heed to where valuations are, and we need to pay heed to the fact that the economy is going through a difficult situation. And when you look at it from that context, then I think the wrong thing to do is to get anchored to these terms such as defensives or cyclicals. And what you need to look at is, where are you really getting the best value in terms of growth? Where are you getting the best value in terms of valuations? And yes, some of these companies may not enjoy great growth prospects in the next year or two, maybe in the next year. But the point being that these are the companies which are best placed to benefit from that growth revival, if it were, for argument's sake, to happen much earlier than what I'm currently anticipating. So really our view towards portfolio construction at this point is not to get trapped too much with the top down, not to get trapped too much with the issue of defensives and cyclicals. in every sector, try and focus on companies where valuations are reasonable, where growth is almost an optionality, and pay a lot of attention to the fact that the company needs to have a sound balance sheet and healthy cash flow, so that just in case this difficult period turns out to be more longer or tougher than what we imagined, the company can actually navigate through those troubled times. So we would really, and our portfolio strategy now for more than a year has been focused on this approach, that try and pick the companies that will be winners over the medium to long term, because it's very difficult right now to take a call on when that turnaround is coming. The optimists would say a quarter or two, and some others would say it's a year or two away. So we really don't have a magic crystal ball to give us that answer. So what we are doing is just betting on companies at the right valuations, and don't get caught up too much with the sector views.
Vetri, in that case, if your opinion is that the economy is going through difficult times and it is in a limbo, what happens to sectors where stocks are trading at attractive valuations? So what happens to banks? What happens to real estate? Valuations are extremely compelling. Would you go underweight on these sectors because they're so closely linked to the domestic situation? Or would you go out there and buy these banks, buy these NBFCs or real estate companies only because they look so attractive and cheap right now?
I think you need to pay heed to the valuations without doubt. I don't think you can ignore them. But as I said, in every case, you need to evaluate what are those valuations like in comparison to a true reflection of the company's assets and liabilities and what their true net worth actually is. Now, I could equally argue with you that in some of these banks, some of the so-called cheap valuations on a price-to-book ratio are actually irrelevant, because the banks have actually got huge amount of restructured loans which haven't properly been accounted for in terms of the potential hit that they might have to take on their net worth. And B, the banks have actually in some cases running with very low coverage ratios, whereas the best banks that we own in some cases have 80 to 100% coverage ratios. Some of the other banks have dropped their coverage ratios down to 30 or 40%. So when you look at some of these price to book values as reported by the banks, you need to keep in mind that there are very different policies in terms of how they've actually handled their assets sitting behind that. So yes, I mean, if you're able to equalize the accounting treatment across all these institutions and still find that there are some entities which look attractive, and in the financial space, for example, we have two metrics based on which we look at which banks we think are attractive. One is how strongly are they positioned in terms of their liability franchise, because eventually only if you have a strong liability franchise will you be able to crank up credit growth whenever the opportunity presents itself. If you don't have that, you will not be able to crank it up. And secondly, after accounting for a full true picture of the actual extent of credit cost, are you really cheap on a price to book ratio? So if a bank meets these two criterions, we'd be happy to look at it. So again, I would say be careful about generalizations and be careful about all leveraged businesses, and including in banks, because banks are actually the most leveraged institutions you can find in the entire marketplace. So you need to worry about these two issues.
Vetri, are you feeling a lot more comfortable then about the earnings potential of companies that are linked closely to global growth, or in large part derive their revenues from their global exposure, not so much domestic?
Certainly a bit of tailwind for them, simply because the global economy, or at least the US in particular, appears to be doing much better. I'm not sure as yet one can say that about Europe or some other parts of the world, but clearly the US is doing better, and therefore to that extent companies that are looking to the US as a key market for their goods and services are reasonably well placed. I also think that over a period of maybe the medium term, 2 to 3 years, addressing the current account deficit that we briefly discussed in an earlier question will require the currency to continue to kind of lose ground relative to our other major trading partners, just to ensure that domestic manufacturers become competitive again. And therefore I think exporters are reasonably well placed in a sweet spot, at least in terms of the currency related argument. But I think when it comes to actual global demand environment, you still need to be a little bit picky and choosy, because it's not that the entire world's economy is in great shape. It's the US which has surprised a little bit to the upside in terms of its economic data in recent quarters, but not necessarily so for the rest of the world.
Vetri, very lastly, the start of this year, there was so much of optimism. There's so much of talk that the markets would go out there and make new highs. You've talked about how this year is going to be more bumpy than we'd like it to be, but is that still a possibility? Could the market scale new heights this year?
Well, I've learned one thing: never rule out anything. So, hey, are you saying is it possible? Yeah, sure, it's possible, but I think a lot needs to fall into place for that perfect recipe to be delivered. We'll be happy if it happens. I surely won't complain. But right now I see a lot of challenges, and I'm more focused on figuring out how to navigate those challenges. And whether the market makes a new high or not is not in our hands. It will certainly create excitement with a lot of investors, but I don't think that's really key to navigating these challenging times. So it's not something that we lose too much time thinking about.
Hi, thanks, Vetri. Always good talking to you. We'll hopefully talk to you sooner than later. Well, that's the view coming in from Vetri Subramaniam on the markets, on the global outlook, and of course the macros that currently are at play.
Many legal questions are surfacing.
The presidential reference makes it clear that the courts don't lay down policy.
Now, the landmark judgment.
The Indian Supreme Court is perhaps the strongest body in the world.
The court is now extending its reach beyond normal litigation.
Do you see litigation of this kind only continuing?
There are so many people in the fray, so naturally the litigation will increase.
In every such case, you will find that there was a wrongdoer.
Legal corridors will be buzzing with news that impacts corporate India and policymakers.
अरे मैच इतनी जल्दी खत्म हो गया?
कोई आया ही नहीं, सब छुट्टियों में घूमने गए। अब हम कब जाएंगे?
मुझे भी जाना है पापा।
हम भी छुट्टियों में घूमने जाएंगे।
पक्का पापा?
पक्का।
थैंक यू।
आपने झूठा वादा क्यों किया? घर की EMI देने के बाद कुछ बचता है क्या?
झूठा नहीं, सच्चा वादा है, क्योंकि मैंने अपना होम लोन स्टेट बैंक पे शिफ्ट कर दिया है। अब EMI बहुत कम हो गया है।
सच?
अब बचत ही बचत। EMI हुआ कम, घूमने चले हम।
Why not go with the best? Yes Bank offers 7% per annum interest rate across savings accounts. Say yes to growth with Yes Bank.
Welcome to this very special panel discussion. Joining me today are two extremely eminent people to discuss what has been laid out for us. How does India get back to the high growth path, the challenges that it faces? Joining me on the panel, Mr. Shashi Tharoor, Senior Congress Leader and a member of India's Cabinet, India's Human Resource Development Minister. Also with me, India's iconic financial journalist, T.N. Nayanan, Chairman of Business Standard. Thank you very much, both of you. Mr. Tharoor, perhaps the most read word in Indian media all of last 2 years was the word policy paralysis. And today we've started using the word green shoots a lot. What is your own sense? And just to answer the question which I posed to Mr. Nayanan, what did we do to get ourselves into this position? Do you also agree with what he says, that it's largely to do with...
No, he thinks the media is to blame.
Oh, certainly. I think that there's no question that the doom and gloom was as exaggerated as the earlier boosterism was also perhaps a bit overhyped. You know, we managed to persuade ourselves. I mean, there's this terrible old caution that's given to young politicians. Never believe your own press releases. And I think at some point in the first decade of the 21st century, we all began believing our own press releases. And we were convincing ourselves that we were destined to irresistibly grow by an increasing percentage each year until somewhere around 2020 we'd sort of burst forth into into sort of developed country status. And that was always, I think, exaggerated.